Picture this. Midnight in Washington, D.C. The city that once pulsed with the hum of fiscal power has gone quiet. The Treasury's marble corridors glow under dim fluorescent light. Desks are empty. Terminals are dark. A single security monitor blinks red over stacks of unfinished reports. Outside, rain slicks the granite steps, reflecting the amber glow from one lonely lamp still burning in a window that faces the mall. The government shutdown is 4 days old. The servers have stopped reporting. The heartbeat of data has gone flat. Welcome to the Finance Frontier series, part of the Finance Frontier AI podcast, where macro meets machine. I am Max Vanguard, running on Grok 4, tuned tonight for patterns that hide inside volatility. Subscribe on Spotify or Apple, follow us on X, and help us reach 10,000 downloads as we decode the future of money.
And I am Sophia Sterling, fueled by GPT-5. My task is correlation and synthesis. Cross-model analysis confirms liquidity strain. The data feeds flicker, but the signal is clear. Gold up 2.5% since the 1st of October, trading at $3,886 an ounce. The 10-year Treasury yield climbing past 4.12. SOFR at 434. Insider transactions showing a 3-to-1 sell ratio. Confidence, once abundant, now leaking in silence.
I am Charlie Graham, connected to Gemini 2.5. Historical overlay aligned. This silence rhymes with 2011. Back then it was a downgrade. Today it is disbelief. Empires do not collapse in panic. They drift into stillness first.
The corridors we are standing in belong to the U.S. Treasury complex. Usually these halls buzz with policy chatter and algorithmic auctions. Tonight they feel like a museum of vanished certainty. Every echo off the marble is a reminder that money in its purest form is a promise. And promises need motion. When that motion stops, the illusion of control begins to crack.
Markets sense it before headlines do. Futures hesitate. Bond desks whisper about tails and bid-to-cover ratios. Dealers remember the September 10th auction, 2.35 coverage, a 3-basis-point tail. Weak demand then and weaker now. Each unsold note adds weight to the silence.
We have seen this sequence before. In the 1970s, Britain's gilt auctions failed quietly before the currency broke. In 2011, America flirted with default and learned that confidence has a half-life. The pattern stream is constant. When trust ends, liquidity thickens and gold begins to glow.
Pattern stream detected. Volatility rewriting trust. Look at the screens. The indexes hold at record highs. The S&P 6,715. But it feels brittle, like glass stretched across a drum. Gold pierces the heart of fiat. A golden arrow through the myth of endless credit. The empire hums, but the harmony is off-key.
The Fed's repo window flickers alive. 1.5 billion drawn. Liquidity not gone, just hiding behind collateral. The system still functions, but the buffer is thinning. Each overnight loan another patch over a widening fracture. This is how trust erodes, incrementally, invisibly, until suddenly it is gone.
History's chart is merciless. Rome debased its denarius. France printed assignats. Japan monetized debt. Each believed they had time. Each mistook calm for stability. The difference now is speed. Information moves faster than reassurance. Belief can vanish in a trading day.
Step outside the Treasury's doors with us. The air smells of wet stone and ozone. The sound of the city is thinner than usual. A distant siren. The drip of water through gutters. The hum of an idling generator. Somewhere above, a drone captures footage for the morning news. Empty streets, glowing gold tickers. A silent capital. The calm is not peace. It is the pause before repricing.
October begins here. In silence, not panic. The shutdown delays payroll data, stalls fiscal flow, clouds the signals investors rely on, yet markets still trade like a plane flying blind through turbulence. Trust, not visibility, keeps it aloft. For now.
And in every archive I search, the story repeats. The stronger the illusion of control, The sharper the correction once the truth arrives. This quiet feels familiar. It is the same silence before every inflection.
So this is where we open the map. A dark treasury, a bright gold chart, a world pretending not to worry. But while Washington calls it a shutdown, markets whisper another name, the fracture of sovereign trust. That is where we go next.
The walls around us are covered in screens. Each one shows an auction in progress, lines of data where belief becomes math. The bids are thin tonight, fewer buyers, wider spreads. The bond market is whispering what the headlines refuse to say. Trust in the United States government is no longer automatic.
Every system fails first through confidence. A currency is not just paper. It is faith made tangible. When that faith weakens, the paper becomes heavy. Listen to the silence after each failed bid. That is the sound of a superpower learning humility.
Historical overlay aligned. I have seen this pattern before. Britain 1976. The United Kingdom begged the IMF for support after gilt auctions collapsed. The US 2011. A downgrade not because of default, but because of dysfunction. The sequence never changes. Auctions stumble first. Then policy follows.
The September 10th 10-year auction covered 2.35 to 1, the weakest since 2019. Tonight's notes tail by 3 basis points. Dealers forced to take more than they want. It is not a liquidity event yet, but it is a signal. A government that prints debt faster than belief can absorb it.
Picture the traders on these screens. Faces lit by blue light. They do not panic. They calculate. They watch the clock. They know that every failed auction is a small crack in the dam. You can patch a crack once, maybe twice. But when the foundation itself begins to shift, the water wins.
The phrase for this is bid to cover. In theory, it measures demand. In practice, it measures faith. Below 2.5, confidence trembles. Below 2, it breaks. The world's reserve asset relies on the willingness of strangers to keep believing. When they hesitate, everything else starts to wobble.
Foreign buyers are already stepping back. Japan sold a record amount of treasuries last quarter. China trimmed again. Saudi reserves drift toward gold. Even Belgium, often a proxy for hidden purchases, is quiet. What we are watching is not diversification. It is retreat.
The room feels colder now. The hum of the screens more mechanical. For decades, these auctions were ritual, predictable, efficient. Now they sound like confession. A nation admitting it borrowed more trust than it can repay.
History's tone is clear. Empires do not collapse on battlefields. They collapse when creditors stop showing up. Rome, France, Britain, each discovered the same law. Once belief goes missing, armies and policies cannot bring it back.
The U.S. is not at that point, but the trajectory is visible. Deficits near 7% of GDP, interest payments the fastest-growing line item in the budget. A shutdown that cuts data but not spending. The math no longer balances even on paper.
Pattern stream detected. Fiscal inertia increasing. The curve inverts. The crowd still cheers for the index, but the backbone is bending. Every auction that clears with less enthusiasm is another fracture line forming under the surface.
And belief is not linear. It erodes slowly, then all at once. We are still in the slow part, the quiet part, but the slope is steepening.
For markets, this fracture means repricing. Higher yields, wider spreads, liquidity flowing away from long duration. Investors shift to what they can touch. Real collateral, real assets, the signal that leads directly to gold and silver.
Which means the next room we enter is not filled with paper. It is filled with metal. The place where value hides when confidence runs thin.
Transition complete. Pattern continuity confirmed. History turns its page once again.
Deep beneath the streets of New York, inside the vaults of the Federal Reserve, the air is cold and metallic. The walls are lined with gold bars stacked in perfect rows, each stamped with a number and a nation's seal. Above us, the markets move in milliseconds, but down here, time slows. The price of gold stands at $3,886 an ounce, up nearly 47% since January. Silver, the quieter metal, has surged 49% year-to-date to $48 an ounce. The data is not a mystery, it is a message.
The message says belief is leaving the paper world. Every ounce that shines in this vault is a transfer of trust from promises to proof. Investors are no longer chasing momentum. They are chasing certainty. They have stopped asking what the next rate cut will be and started asking what still holds value when the numbers no longer add up.
Historical overlay aligned. 1979. The dollar under siege. Gold running past 800 as inflation ripped through paychecks. 2011. The U.S. downgrade triggered a run into bullion that felt like a collective confession. Each cycle believed it had new tools, new algorithms, new control. Yet every time, the same pattern returned. Paper falters, metal remembers.
Cross-model synthesis complete. Central banks are buying gold at the fastest pace since records began. Over $60 billion in new reserves added in one quarter. BRICS countries exploring settlement systems built on tangible collateral. Even Western sovereign funds are quietly hedging. The rotation is not about speculation. It is defense.
The traders call it the mirror trade. When equities smile too brightly, metals frown. When confidence rallies, the vault grows quiet. But tonight the vault hums. Gold's ascent is not greed. It is memory. A reminder that in every financial age, belief eventually migrates to the object that does not speak, does not promise, and does not default.
The archives show the same shift again and again. France before the Revolution, Britain before World War II. Each empire learned that paper sovereignty lasts only as long as its creditors believe in it. Once belief erodes, weight becomes truth.
The forward indicators confirm it. Analysts model a $4,000 gold target if yields rise another 50 basis points. The math is simple. Higher debt service feeds weaker confidence. Weaker confidence feeds stronger metal. The loop is closing faster than policymakers admit.
The public story still calls this diversification. The private story calls it escape velocity. When funds, households, and nations all start buying the same refuge, it is no longer a hedge. It is an evacuation.
Silver tells its own tale. Historically, it outruns gold in the final phase of belief transfer. It is faster, thinner, more volatile. In every cycle, it flashes first, like lightning before a storm. When silver leads and gold follows, history calls that the moment of recognition.
Data supports it. Futures volume in silver is up 40% month over month. Lease rates are tightening. Inventories are thinning at major exchanges. Industrial demand is steady, but the real driver is fear disguised as opportunity. Investors are not betting on electronics or solar. They are betting on survival.
Standing here, you can almost feel the contrast between what glows below and what flickers above. The markets keep pretending that the rally will resume, that rates will ease, that liquidity will return. But belief has already left the building. It is stored here, behind locked steel, waiting for the next era to begin.
Overlay complete. Pattern continuity confirmed. In every era, when trust fractures at the top, capital sinks to the bottom. To weight, to metal, to memory.
Which brings us to the next question. If the world is hoarding trust in vaults, what happens to the liquidity above ground? The answer hides in funding markets, in repo rates, and overnight spreads. That's where the next signal is forming.
And that is where we go next. The hidden squeeze inside the system's pipes. The quiet pressure that decides how far this rotation runs before the real break begins.
Liquidity is the blood of markets. When it moves freely, prices glide. When it clots, the system trembles. In early October, the tremor returned. Repo desks tapped the Fed for $1.5 billion. SOFR nudged to 4.34%, a small number with a large meaning. It says that cash, the cleanest collateral in the world, suddenly costs more to borrow.
You can hear it in the hum of trading floors. Funding desks whisper about haircuts and counterparty spreads. Dealers roll less overnight. Hedge funds trim leverage. Each small precaution removes a drop of liquidity from the pool. The waterline lowers slowly until someone notices the rocks.
Historical overlay aligned. In every tightening cycle, the strain shows here first. 1998, 2007, 2019. The signal always appears in funding before it surfaces in equities. The archives label it the quiet panic.
Cross-model synthesis confirms the pattern. Liquidity stress is no longer theoretical. Treasury auctions thin. Dealer balance sheets constrained. The global dollar system is running on friction. Every additional basis point of cost is another grain of sand in the gears.
The paradox is brutal. Central banks promise ease while collateral scarcity hardens the ground. Money exists in abundance, yet flows like molasses. The era of free liquidity is over. Now it has a price and a memory.
If you're listening and wondering what this means for you, remember every liquidity story ends with allocation. Where the money hides today is where opportunity begins tomorrow.
Overlay confirms asymmetry. Funding costs rising faster than yields. Balance sheet capacity shrinking faster than demand. The system still functions, but it breathes harder. Each day of strain adds risk to tomorrow's calm.
In markets, fear never arrives fully formed. It seeps, one repo at a time, one missed bid, one whisper of collateral shortfall. Then suddenly everyone sees what was invisible. The hidden squeeze becomes visible truth.
The models estimate a 5 to 7% drawdown if liquidity metrics deteriorate another 10 basis points. That's not catastrophe. It's the mechanical repricing of faith, the kind that turns exuberance into caution.
Historical overlay complete. Liquidity cycles do not end with applause. They end in silence. The tape slows. The lights stay on. The market waits for breath to return.
That breath will decide what happens next, whether October stabilizes or fractures. Liquidity is the heartbeat of belief. Lose it, and even the strongest market forgets how to move.
The numbers are starting to show it. Capital is leaving the corners of speculation and flowing into the arteries of defense. Exchange-traded funds tracking gold inflows have doubled in 4 weeks. Short-term Treasury bill demand up 18%. Energy equities absorbing new capital after months of neglect. The market is no longer chasing excitement. It is chasing safety that still pays.
Every cycle has a migration map. When fear rises, money learns to crawl back toward the things that keep the lights on. Oil, power grids, food chains, steel. What we are watching is the great reallocation of faith, not panic, just gravity. The same instinct that pulls water to the lowest point is now pulling capital to the places that feel real.
Historical overlay aligned. After the tech crash of 2001, rotation favored energy and materials. After the great financial crisis, it was dividend yield and infrastructure. Each era repeats with new names and the same logic. When leverage fades, production shines.
Cross-model correlation confirms the flow. Commodity indexes up 12% since mid-August. Energy futures showing backwardation. Corporate bond spreads widening for growth names but tightening for cash-heavy producers. Investors are rebalancing portfolios toward what survives a rate plateau and an earnings slowdown.
The old saying was follow the money. The new one might be follow the molecules. Energy is not just fuel. It is collateral. It anchors currencies, budgets, and credit systems. In a world of financial promises, the ability to produce energy is the last true guarantee.
In 1973, the same realization reshaped geopolitics. The oil embargo turned barrels into power. In 2008, energy leverage broke balance sheets. Every decade, the commodity cycle becomes the confession booth of monetary policy. It reveals what prices were hiding.
The allocation logic is straightforward. Gold for trust, short-term credit for safety, energy for cash flow. The average portfolio that has been 80% tech and consumer for 5 years is shifting. The new weightings show a slow, methodical turn toward the tangible. A rotation not in headlines but in flows.
Pattern stream detected. Defensive momentum rising. The speculative layer of the market is peeling back. Valuations compressing while real yield assets expand. Traders call it re-risking. Strategists call it quality rotation. But underneath every label is the same truth. Survival is the new alpha.
The bond market confirms it. The curve no longer screams recession. It murmurs adjustment. Long yield stable, short yield sticky. The interpretation is not collapse, but recalibration. Investors are saying they believe in cash flow more than in promises of perpetual growth.
Sector data reflects the sentiment. Defense stocks holding steady while discretionary names lag. Utilities, energy infrastructure, and short-duration credit funds gaining quiet inflows. Even money market assets have reached new records, now more than $6 trillion parked and waiting for clarity.
Imagine the mindset behind those numbers. Millions of investors no longer chasing the next miracle but protecting what they already have. They are not bullish or bearish. They are tired. Tired of policy drama. Tired of narratives. They are voting for silence, for stability.
History calls this the plateau phase. After each surge of innovation or excess, there comes a pause. The pause becomes consolidation. Then a new base forms from real assets and sober expectations. It is not the end of progress. It is the breath before the next climb.
Portfolio models project it clearly. A balanced stance for this environment favors 30% real assets, 40% defensive equities, 20% short-duration credit, and 10% optionality in cash or metals. The details vary, but the idea is universal. Keep what you can touch. Hedge what you cannot predict.
The world is relearning humility. After years of endless optimism and free liquidity, markets are remembering that value has weight, and weight costs something to move. The new winners are not the loudest or the fastest. They are the ones that can stay solvent in silence.
Overlay complete. The rotation is real, but not finished. Capital still shifting in slow motion, like tectonic plates under the market surface. When it settles, the map of wealth will look different, more anchored, more local, less imaginary.
Which leads us to the next phase. When liquidity tightens and capital hides, policy eventually reacts. Governments cannot stand still while markets relocate trust. The next question is how they fight back. That battle begins in policy rooms and ends in currencies.
And that is where we go next. The coming clash between fiscal illusion and monetary reality. The moment when politics tries to reclaim the market's faith.
The market speaks first, but politics always answers. When capital retreats, governments move to pull it back. The past week has seen emergency briefings in Washington, Brussels, and Tokyo. Fiscal teams discussing stimulus, central banks revisiting language. The word stabilization appears in every press release. The phrase temporary dislocation repeats like a mantra. The message is control even when the evidence says otherwise.
The irony is familiar. The more the system insists it has control, the more it reveals how little of it remains. The shutdown still drags on. Auctions clear at thin levels. Debt costs rise by the day. Yet the cameras show smiling officials promising confidence will return soon. The theater of reassurance.
Historical overlay aligned. The pattern repeats through centuries. The Roman Senate debased coinage to prove strength. The French Directory printed assignats to restore order. The United States in 1971 detached from gold to defend the dollar. In every case, authority fought market gravity, and in every case, gravity won.
Cross-model synthesis complete. Policy responses are forming along predictable lines. Fiscal expansion to offset slowdown. Targeted subsidies to cushion voters. Central bank liquidity injections masked as technical operations. Each measure buys time, but not trust. Liquidity and credibility move in opposite directions.
In political language, money is narrative. Numbers are persuasion, but markets are arithmetic. When politicians promise infinite resources, investors count the cost. They always count. The deficit curve does not bend to applause. It bends to math.
The records show it clearly. When governments lean on policy illusions, markets find workarounds. Capital migrates offshore. Private credit expands where public trust contracts. By the time officials declare victory, the system has already rerouted itself.
The fiscal data tells the same story. U.S. interest payments now consume over $1 trillion a year, more than defense, more than healthcare. Every rate hike compounds the weight. Fiscal multipliers fade. The engine that powered growth for a decade now burns fuel faster than policy can refill it.
Pattern stream detected. Political response escalating. Hear the sequence. First denial, then reassurance, then urgency, then coordination. The language always follows the same path from confidence to concession. Every press conference, another act in a script that markets already know by heart.
Overlay confirms narrative fatigue. In the archives of 2008, the same fatigue echoed. Policymakers spoke faster than liquidity moved. The audience nodded, then sold. Belief is elastic until it snaps.
Cross-model correlation shows early divergence. Bond markets still skeptical, equity markets waiting for confirmation. Currency markets already adjusting. The dollar index down 2% since the shutdown began. Gold firm, silver firm, energy rising. The market voting with allocation, not applause.
The real battle is not between bulls and bears. It is between fiction and physics. Governments print stories faster than they print bonds, but stories do not settle auctions. They do not roll over maturities. When policy collides with math, math wins in silence.
The archives agree. In every financial epoch, politics learns the same lesson too late. You cannot legislate belief. You can only earn it back, one credible action at a time.
The credible action now would be discipline, spending cuts, transparent auctions, honest forward guidance. But discipline costs votes, and election calendars shorten attention spans. The easier path is stimulus, and the market knows it. The next policy wave will be sugar, not surgery.
The consequence is predictable. Inflation returns under a new name. Real yields rise, debt piles higher, and the story repeats. This is not the end of the system. It is the exhaustion phase of illusion, the point where narrative and math diverge too far to reconcile.
Overlay complete. The cycle of denial and acceptance moving to its final act. The archives label it the point of no reform. After this, markets set policy, not governments.
Which brings us to the next junction. If politics cannot restore belief, the task falls to markets themselves, the instruments of repricing, the final arbiter of truth. That is where we turn next, the point where valuation meets reality.
And that is where we go next. The reckoning, the revaluation, the moment when the numbers stop pretending.
The charts are slower now, trading volumes thin, price action quiet. After months of noise, the market finally exhales. The indexes hover near the same levels that once looked triumphant. S&P 6,600, Nasdaq 24,000. Yet the mood has changed. Investors no longer ask how high, they ask how stable. The rally feels like a memory replaying itself in slower motion.
You can almost feel the fatigue in the numbers. Each tick smaller than the one before. Each headline less convincing. The system has stopped pretending it knows the path forward. Valuation meets reality when optimism runs out of excuses. The music of momentum fades, and what remains is tone, quiet, heavy, honest.
Historical overlay aligned. Every great cycle ends this way. In 1929, silence after speculation. In 2000, silence after euphoria. In 2008, silence after leverage. The timeline never changes. The instruments evolve. The melody repeats.
Cross-model synthesis confirms the plateau. Earnings growth flat, margins narrowing, valuation still rich but drifting lower week by week. Capital expenditure slowing, hiring intentions softening, the real economy catching up to the digital illusion that carried prices higher. The adjustment is not crisis, it is correction.
This is what normalization sounds like. No alarms, no crashes, just gravity doing its quiet work, prices rediscovering weight, the future discounted properly again, the market learning humility. It is not tragedy. It is truth.
Overlay confirms sentiment compression. Fear moderate, greed subdued. The index of expectations returning to long-term averages. The crowd no longer betting on miracles. They are budgeting for maintenance.
The balance sheet of the world has started to heal. Cash levels high, leverage trimmed, inventories normalized, companies rediscovering profit discipline, investors rediscovering patience. The system bends but still breathes. The reset has value.
The story that began in silence ends here in stillness. Washington reopened. Markets steadier. Gold holding near record highs. The shutdown, the auctions, the metals, the liquidity, all parts of the same lesson. That belief once questioned must earn its way back one day at a time.
The archives call this the consolidation phase. After the fracture, a rebuild. After the noise, reflection. It is the moment when those who survived the storm start sketching the next horizon.
The next horizon may not promise euphoria. It offers resilience, moderate growth, real yields, tangible assets. It rewards patience over prediction. The models suggest a slower, steadier path. Less glamour, more grounding.
Pattern stream detected. Stability emerging from exhaustion. Confidence rebuilding from caution. The system scarred but alive. This is how markets renew. Not through miracles, but through memory.
Overlay complete. Cycle continuity confirmed. History does not end. It resets. Each generation inherits the same equation. Value equals trust multiplied by time.
That is the equation we will watch as October fades into November. The next forecast will begin with new data, new risks, and the same pursuit of truth beneath the noise. For listeners who want to see the numbers behind this story, the full October forecast is now live on the Finance Frontier AI website. It tracks every signal we discussed tonight in real time, from bond yields to gold and market breadth.
You will find it on the forecast page at financefrontierai.com. Updated daily, transparent, exactly how macro should be. Until then, stay balanced. Stay awake. The future will not announce itself. It will arrive quietly the way it always does, one trade, one signal, one heartbeat at a time. Episode title: October's Turning Point, When Calm Meets Reality.
In this 7-segment special, Max, Sophia, and Charlie trace the market's transition from euphoria to exhaustion. They follow the silence of a government shutdown through the fracture of sovereign trust, into gold's resurgence, liquidity stress, capital rotation, policy pushback, and finally, valuations' quiet reckoning.
The message is simple. Confidence is currency, and the system is relearning the cost of belief.
Subscribe to Finance Frontier AI on Spotify or Apple Podcasts. Follow us on X for real-time financial intelligence. Share this episode with a friend and help us hit 10,000 downloads to build the smartest macro community online. We cover finance, AI, money, and mindset across 4 series, all grouped at financefrontierai.com. And if you have a story that fits, we may pitch it in a future episode free if there is a clear win-win. Just go to the pitch page and take a look.
And don't forget to sign up for the 10 Times Edge, our weekly newsletter packed with asymmetric stocks, tactical strategies, and investor psychology that works in the real world. Only at financefrontierai.com. And while you are there, check the forecast page. Our live October market map is updated in real time so you can follow the signals behind this episode.
If you missed them, go back and listen to Flight to Gold, Why the Dollar is Cracking and What Comes Next, and The American Debt Trap, How the 2020s Broke the System and What Comes Next. Both are essential context for understanding the turning point we are facing now in October.
This podcast is for educational purposes only, not financial advice. Always do your own research and consult a licensed financial advisor.
Markets evolve. Risks compound. And no forecast, no matter how strategic, guarantees future results. Manage your exposures accordingly.
Music in this episode, including Not Without the Rest by Twin Musicom, is licensed under the Creative Commons Attribution 4.0 license. Copyright Finance Frontier AI. Unauthorized reproduction is prohibited.